One of the big mysteries of today's economy is why are stocks holding up so well even as inflation swells and growth goes limp? And it turns out there is a very simple explanation. Just 7 stocks are holding up the entire stock market. A few months ago, S&P Global tallied up the numbers, finding that the so-called Magnificent Seven, that's Apple, Google, Facebook, Microsoft, Amazon, Tesla, and Nvidia, accounted for fully 110% of stock market gains year to date. In other words, the good part of the economy is 7 companies. The bad part is the other 5,993 companies. Even that, however, has got a big grain of salt, since most of the Magnificent Seven was essentially bouncing off a disastrous year in 2022, when stagflation fears drove Apple and Microsoft down 30%, Amazon and Google down by half, and Tesla and Facebook dropped almost 2/3, making 2023 pretty much a dead cat bounce in market lingo, a warm day in the middle of winter. So that pretty much leaves Taiwan-based Nvidia as the only bright spot in the American economy. Now, investment analyst Jim Bianco updated the tally a couple weeks ago. He found that not much has changed, with that same Magnificent Seven accounting for fully 98% of stock market gains all the way through October, while smaller companies were flat to negative on the year. So-called microcaps, meaning companies worth less than 350 million, actually lost 8.5% of their value over the course of the year. So what is happening here? Now, generally speaking, big business is built for the Biden economy, meaning that they have lobbyists on speed dial, they have expensive lawyers and tax accountants on permanent retainer, and they have impressive compliance departments that can laugh off regulators that kill their smaller competitors. But that is only half the story, considering that every single one of the Magnificent Seven is a tech company. Plus the fact that the tech-heavy NASDAQ has outperformed the rest of the market over the course of the year. That suggests something else is happening, that it may be more about risk appetite, specifically that markets relaxed about stagflation as headline CPI has been coming down the past year, because falling CPI suggests that the Fed could cut rates sooner, which turns back on the easy money drug that feeds tech stocks, growth stocks in general. If that's what's happening here, then it means the entire stock market is held up by a 7-company string, which is itself duct taped to a greasy patch of head-faked CPI. Meaning when and if financial markets finally notice that inflation is stuck, in fact it's rising, the very last leg could come out of the stock market. So what's next? Brought to you by Unchained. For the past 6 months, I've characterized investing in stocks as picking up dimes in front of steamrollers. With money market accounts now paying 5%, it is hard to see how stock investors are getting paid for the risk. And so for many, it is becoming a very good time to pull some cash out, to park it at 5% and see what's next. Note, I could always be wrong. I, for one, did not expect COVID to send the S&P up 50%, but 7 stocks and a CPI on the move is a very fragile place to invest your life savings. Okay, we'll be watching. See you next time.